In this video, we'll go over factors that banks and lenders use when it comes to determining approvals or pre-approvals when it comes to mortgages. This is included in our first-time home buyer series dedicated to new Canadians. In this video, we'll break down how banks and lenders think so that you can position yourself to get the best rate possible. And that's coming right up.
Money does not possess me. Money? Or is it money? Somebody gonna have to tell the truth, and I'm gonna tell it.
Hey, I'm Hervin Pesa. I'm a financial planner based out of Calgary, but just like you, I'm on a journey to building wealth and financial independence. My mission is to help Canadians build wealth so that they can live a life of meaning and joy. So I post weekly videos talking about money lessons we didn't get from school. So if you're ready to take control of your money and want to join us in this journey, consider subscribing and be sure to hit the bell so you never miss a lesson when it drops. To be clear, I'm not a mortgage professional. I'm just a guy from YouTube fishing for likes, shares, and comments. So don't take any of this information as financial advice. Always consult an advisor that actually knows you and your personal story, not just some random guy on the internet. If you need an introduction after you watch this video, leave me a DM and I will get you in touch with somebody that I trust. We are not going to do a lot of math in this video. Instead, let's go through principles that you need to consider when you begin your mortgage qualification process. So let me say this. You need to know thy enemy. I want you to imagine that you are the bank. Let's say you are in charge of underwriting or approving the loans. Better yet, let's say it's your money that you're lending out. What would you need to consider to make sure you can lend out your money as profitably and, more importantly, as safely as possible and increase the odds of you getting paid back? Let's go through a basic framework on how lenders would charge borrowers and whether they would even facilitate the loan or not. Let me introduce you to the 6 C's of lending. Some say 4, some say 5, but I'm feeling pretty 6C myself.
Oh, that's hot.
I'm here all week, folks. So let's go through the 6. Character, credit, capacity, capital, collateral, and current conditions. Character. Character is about you, the borrower. Do you have established records of being able to pay your bills on time? Lenders can easily check this with a credit report. The credit report tells the lender about your previous behavior with debts. Did you pay on time? Or are you always out looking for new loans? Are you consistently maxing out what's available to you? Think about it. If you were the banker, would you lend to this guy?
Yo, is this thing on? Yo, bro, Herbs, can you spot me 100? I'll pay you back. I promise I'm good for it, man. Come on. Please. Alright. Hey, good afternoon. Thank you for taking my call. I just wanted to let you know that I've CC'd our accountant and he should be sending you our financial statements for the last 3 years, and of course our tax records are going to be there. I wanted to make sure that you guys get acquainted because if there's any financial questions, he probably has a quicker response time than I do. So that's it. Cheers.
Credit score. Credit scores range from 300 to 900 and it has 2 important roles in your mortgage application. Most lenders will look for an approval at about 620 to 680 as the minimum as the first bar. After that, they have a range of scores that will determine the rates that you will be charged. Think about it this way. The higher the score, the lower the risk for the lender. This means lower interest rates are charged to those borrowers. Someone with a better score will save thousands, maybe tens of thousands in interest costs over their lifetime. The problem is the scoring system is confusing. It's like playing soccer on a basketball court while trying to score a home run. So make sure you subscribe and get notified so that when I publish the video about boosting your credit score, you stay up to date. For now, all you need to know is that lenders have a minimum requirement and that they can start changing the rates and charging less as you go over that. The next C is capacity. Capacity talks about your ability to pay the loan and what percentage of your income goes into paying the mortgage and other debts. your source of income, the stability of it, and how long you've had that income source for also plays a role. See, for individuals with multiple jobs, some lenders could choose to only include a portion or none of your second job if they believe that that source or that work arrangement is not sustainable. There are two common calculations for capacity. The first one is the gross debt servicing, or GDS. This shows what percentage of your annual income goes to paying the mortgage and related expenses. Number two is the TDS, or the total debt servicing, which shows what percentage of your income is going to servicing all of your loans, including car loans, student loans, credit cards, what have you. Most lenders prefer that loans don't exceed 30% of your GDS, meaning no more than 30% of your income goes into paying the mortgage and related expenses, while your TDS, or your total loan servicing, cannot exceed 40% of your annual income. The CMHC actually caps this at 35% and 42% respectively. This is a perfect segue into the secondary capacity check. See, if you put down less than 20% as your down payment, you will be required to purchase default insurance, and the insurer, Sagen, CMHC, or Canada Guarantee must approve your mortgage application. It's not just up to the bank or the lender. You can be in a situation where the bank gives you an A-OK, but the insurer declines that application. So you need to be aware of that. Up next is the stress test. In 2018, the government put in place a mortgage stress test. The heart of this was to check if you would still be able to afford mortgage rates that would potentially go up in the future. So since 2018, your lender would have had to run two GDS and TDS calculations. One's for the rate that the lender is actually willing to give you right now, and the stress rate, or the test rate, which is usually higher. The next video is gonna give us a breakdown for mortgage affordability, which will discuss all of these in further detail and sample calculations. Before I move on, can I ask you to please take a second and like this video so that our channel and the resources we aim to provide can be discovered by people like you and others who need this type of information. For additional resources such as calculators and worksheets, go to ourfirstplace.ca. And could you kindly leave me a comment, ask me questions, anything, even put a tomato if you don't find us helpful. Looking forward to it. Next is capital. Capital is skin in the game. Capital provided for the mortgage application or your down payment matters. And of course, capital for the rest of your financial assets matters. Where you get the down payment, that also matters. See, there is a higher correlation between defaults and borrowed or gifted funds when compared to traditional down payments such as savings and personal assets. Again, think of it like a banker. Put your banker hat on right now. If you had to choose to provide funding between two applicants, this guy, here you go, sir. That's my last dime, but that completes $25,000 for my down payment. Or somebody that has other assets, other savings that they could draw from if they had temporary loss of income. It's common for your mortgage broker to complete a net worth statement that goes beyond the loan. They do this to prove source of capital, and they use this to make your application more favorable. Here's a video in the links showing you how you can create and read a net worth statement so that you have this information ahead of time. Collateral. When you apply for a mortgage, you are putting up the home as your security or collateral for the loan. If you default, the mortgage lender can foreclose on the property, sell it, and recoup the unpaid loan. Let's say you're the lender again. Will you be willing to lend $500,000 for a property that is only worth $250,000? If the borrower defaults, you're only gonna get half of what is owed. See, lenders typically bake in a margin of safety for this reason. They will only lend up to 95% of the value of the property for a conventional mortgage or up to 65% for a home equity line of credit. See, if you came to me asking for a $100,000 loan and I have a 30% margin of safety, I would make sure that the asset you're putting up as collateral is worth at least $143,000. If you didn't pay me back, I would get the $143,000 asset. This is also why lenders could request an appraisal and sometimes even an inspection for the property, because it has to be habitable. This is the reason why it may actually be more difficult to get financing for a fixer-upper compared to a brand new build. The final C on the list is current conditions. This one is a little bit harder to grasp, but let's just go back to our lending position. If you're the lender, you're in the money business, and your inventory is the cash you're gonna lend out. Let's say you had $1 billion that you could lend out this year, but there are 10,000 applicants trying to purchase homes that are worth on average $500,000. You will not be able to lend to everyone. You're capped at about 2,000 files. So what would you do? Well, I would prioritize applicants with excellent credit. Let's go and prioritize people with 760 scores first. Ding, 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 ding. Correct. Unfortunately, that eliminates you. Thanks for playing. See, this is a weird one because depending on market demands, even though you may be a strong candidate, if a lender has changed their appetite on loans that they're willing to underwrite, there may simply be other applicants that appear to be lower risks for them. So it's not you, it's me. I mean, it's them. So why did I go through all of this? And why do I keep repeating know thy enemy? Well, they're not really your enemy, but you need to understand how lenders operate so that you can plan ahead and give yourself the best chance of getting approved at lower rates. You can make sure that you're not applying for loans right before or in the middle of your home purchase. You can plan ahead and build up your credit score. You can make sure your income is high enough for your budget and your dream home, especially if you're self-employed or you're a business owner. We often do everything in our power to minimize taxes and reduce our income on paper. While this saves money on taxes, it could mean being disqualified from the mortgage we need for the home that we want. This is especially important if you're going from self-employed to an incorporated business structure. Some lenders might wait until you have at least 2 years of corporate income taxes filed, even if you've been in the same business for years and years and years before that. You can also make sure that the source of your down payment is in your bank account long before you get the process started. This could save you time and effort for proving fund sources. You can make sure that the house you want to buy meets lending standards. This means inspections, which by the way would protect you anyway. And finally, to navigate through current conditions, you can work with a mortgage broker that has affiliations with different lenders who have different lending criteria and different appetites for different buildings, for different structures, and just different people. Be sure to check out ourfirstplace.ca for additional resources and links to personal recommended professionals. The next video will explain affordability and the calculation for capacity when it comes to lending and getting qualified. Watch that here. Until next time, stay aware, take control. Love you all. Peace out.